Hello friends, welcome to our channel Accounting by FARSK. This is our series on the set of videos on reading the financial statement 7 of 7, financial analysis 1 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. Today's video is all about the financial statement, which is another very important for the owners and shareholders of the company, and that is financial analysis 1 of 2, the language of business. In today's dynamic and competitive business environment, having a fundamental understanding of financial statements, the so-called language of business, is essential for anyone involved in strategic decision making. Financial statements provide a clear, structured view of a company's financial performance, position, and overall health. They serve as vital tools for evaluating profitability, assessing risk, understanding operational efficiency, and guiding investment or management decisions. Whether you are a business owner, manager, investor, or student of finance, this ability to read and interpret these statements is an indispensable skill. Throughout this video, we delved into four primary financial statements that form the foundation of corporate financial reporting, and that is the balance sheet, the income statement, the statement of cash flows, and the statement of retained earnings. We examined not only how to read each statement but also how to interpret the information they provide and analyze the interconnections among them. These relationships helped us uncover deeper insights into a company's operations, such as how net income flows into retained earnings, how cash is generated and used, and how assets are financed through liabilities and equity. By the end of this video, we gained not only theoretical knowledge but also practical analytical skills that are directly applicable in real world scenarios. We now understand how to critically evaluate financial information, interpret trends, and use financial data to support sound strategic business decisions. Ultimately, financial statements are more than just numbers. They are comprehensive narratives that, when analyzed correctly, offer powerful insights into a company's past, present, and potential future. A critical evaluation. Let's begin by understanding what we really mean by financial statement analysis, not just as a process, but as a critical thinking exercise that lies at the heart of smart business decisions. Definition and purpose. Financial statement analysis refers to the process of critically evaluating the financial data presented in a company's financial reports, such as the income statement, balance sheet, cash flow statements, and statement of retained earnings. But it's not just about reading numbers. It's about understanding what those numbers really mean. This process helps stakeholders assess a company's profitability. How well is the company generating income? Evaluate operational efficiency. Are resources being used effectively? Measure liquidity. Can the business meet its short-term obligations? Judge solvency and sustainability. Is the company capable of surviving and thriving in the long term? Predict the future performance. Based on historical and current trends, the dual nature of analysis plus interpretation. Effective financial analysis has two essential components, and that is analysis and interpretation. Analysis. What's the meaning of analysis? This is the technical process of breaking down complex financial data into understandable parts. It involves categorizing data, calculation of ratios, and comparing trends, identifying relationships between variables like sales and profit or assets and liabilities. And second is interpretation. This is the logical reasoning and explanation behind the numbers. It answers questions like, what do these trends indicate? Why did the profitability decrease despite higher revenues? That may be because of the discounts allowed. What do these ratios tell us about the company's risk? Are we giving more discount? Without analysis, you are looking at a raw data with no structure. Without interpretation, you have structure but no meaning. One is incomplete without the other. Just like in medicine, lab tests are analysis, but diagnosis is interpretation. Together, they inform the right treatment. Similarly, in finance analysis, plus interpretation is equals to informed decision making. Why it matters. This process of critical evaluation is essential for managers who need insights to guide operations and strategy, investors who need to decide where they need to put their money, creditors who assess the company's ability and to repay debts, regulator who ensures financial transparency and compliance. Whether you are assessing the past, managing the present, or planning for the future, financial statement analysis equips with the tools to do it responsibly and effectively. Financial statement analysis is not just about what the numbers say, it's about what they mean, why they matter, and how they shape decisions. It's a blend of art and science, a technical breakdown of figures followed by a thoughtful interpretation of their real world implications. When done right, it becomes the foundation of sound financial judgment and sustainable business growth. Why financial analysis important to various stakeholders? Finance managers. Finance managers use analysis to assess creditworthiness. Can the company repay loans or obligations? Operational efficiency, are resources being used effectively to generate profits? And of course, financial controls. Are budgets, costs, and cash flows under control? Making informed decisions based on tools like ratio analysis and cash flow trends. They rely heavily on ratio analysis, profitability, liquidity, and solvency, and of course, cash flow analysis in order to monitor cash inflows and cash outflows. This helps them plan budgets, approve expenditures, and manage working capital, and also to ensure the financial stability of the company. Top management ensure efficient resource allocation or utilization, evaluate strategic direction, and monitor overall financial health. They use the analysis to set long-term goals, restructure departments, make investment or divestment decisions, and also to track if operations align with the company's visions and profitability goals. Trade payables assess the short-term liquidity and the firm's ability to meet the obligations. That is short-term liquidity. Can the company pay its bills on time, and also the cash flow position? Is there enough operating cash? Lenders focus on long-term solvency and repayment capacity using profitability and capital structure analysis. They analyze the profitability trends, debt to equity ratio, interest coverage ratio, and last but not the least, cash flow to debt servicing. Lenders use this information to decide loan terms, interest rates, and whether or not to approve funding. Investors analyze earnings potential, capital structure, and managerial efficiency to make buy or sell decisions. Investors use financial analysis to evaluate earnings potential, stability of returns, and risk levels. They look at the following from the financial statements: earnings per share (EPS), dividend payout ratio (DPR), return on equity (ROQ), and of course management performance. This is because their ultimate goal is to decide whether to buy, hold, or sell the shares, as investors want growth with controlled risk. Labor unions review financial capacity to support wage increases, assess if profits justify better working conditions, and negotiate for bonuses, benefits, or job security. And for this, they focus on the net profit, cost of wages as percent of revenue, and cash reserve. This helps in preparing for collective bargainings and negotiations. In short words, negotiate for better pay. Economists and government agencies use it to understand the business trends and inform regulatory or policy decisions. For example, tax departments assess profitability for tax planning, regulatory bodies check compliances with the financial laws, and central banks use aggregated data for monetary policy. They rely on macro-level trend analysis, common size statements, and cross-sector comparisons. Now coming to the objectives of financial analysis. Now let's talk about the core objectives of financial analysis. Why do we even analyze financial statements in the first place? Financial analysis serves several critical purposes that go far beyond just crunching numbers. First, it helps us evaluate the current profitability and operational efficiency of a business. By analyzing revenues, costs, and margins, we can determine whether the company is generating sufficient profits and managing its operations effectively. Second, it allows us to understand the relative importance of various financial components. For example, how much of the company's capital is tied up in inventory and or how dependent it is on borrowed funds. This perspective helps in identifying areas of strength and concern. Third, financial analysis helps in identifying the root causes of changes in financial performance, whether it's an increase in expenses, a dip in sales, or a rise in debt. Proper analysis uncovers the why behind the numbers. Fourth, it assesses the company's liquidity and solvency. Liquidity tells us whether the business can meet its short-term obligations, while solvency evaluates its ability to survive and thrive in the long term. Fifth, it plays a key role in supporting both investment and operational decisions. Whether it's deciding to expand operations, enter a new market, or acquire another company, financial insights guide these decisions with data-driven confidence. And finally, financial analysis, financial analysis is vital in assisting governmental bodies and regulatory authorities. It provides transparency, supports tax assessments, and informs policy decisions, making it a cornerstone of financial governance. In summary, financial analysis is not just about what the numbers are, it's about what they mean and how can guide smarter decisions, ensure accountability, and promote long-term success. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounting by FARSK.